Okay, so I mean, we're gonna talk about decentralized yield-bearing stablecoins. The focus is gonna be on where the yield comes from. Maybe we can get a round of introductions from our participants. You know, like who you are, what's your protocol, the protocol you're with, and like a one-sentence take on yield-bearing decentralized stablecoins. Go.
Yeah, I'm Martin. I work for Curve. I'm BD at Curve. We have like Curve USD. I know the system pretty well, in the sense that I know where the yield is coming from. We have Curve USD is a decentralized stablecoin. We have a saving version of this, and the saving version has like is yield bearing, and the yield is coming from the minting fee from Curve USD. So it's real forwarded income of the protocol.
I'm Boyan from Liquity, which is a CDP. We came out recently with a V2, which also has now 2 yield-bearing stablecoins developed by external parties. So people who just built on the primitive we want V2 to be. And the yield is coming from mostly from just borrowers paying interest on their loan.
Hello, I'm Kappa Joseph. I'm working on the Nerite protocol on Arbitrum, which is a fork of Liquity, and the yield part works exactly the same, except you can do more with Nerite because the stablecoin is also streamable. So that we'll talk more about that, hopefully.
Awesome. Well, so back in 2019, I was doing like a OTC lending markets, and I was on a very interesting call with Kyle from 3 Arrows. And he said, you look like yield comes from 2 places: degens looking for leverage and token emissions. That's it. So 6 years later, like are we still there? Are there like new sustainable forms of yield?
No.
Yeah, no, it's the same. For Curve, it's the same. You take, you know, you can say you have conservative users who don't. We have like the D-chain who leverage up. They pay. They use mint Curve USD. They buy more crypto assets. They leverage up. So they pay for this, and then we forward part of the revenue make to the most conservative users, the as Curve USD holders, and yeah, it's still the same basically. Yeah, this case.
Yeah. Same.
But then, although you know, they're nuanced, not exactly true. You know, like some of we have an AMM, so you go into a pool, so you can earn some trading fees. So it's like this is also a form of. Is it speculative? No, I would. Yeah, maybe, but maybe not. You know, it's just a market.
So, RWAs are like a massive topic, and in essence, 90+% of the RWAs today is just like a tokenized treasury, and it's allegedly like not allegedly, it's like another form of yield. But can that be done in like a decentralized manner, or is that because like would that always be constrained to like I need legal enforcement and game over?
If it's controlled by the United States government, there's not a way to do that trustlessly without their permission or in a way that they can't seize it whenever they want. So I don't think that's very interesting. What's more interesting to me in RWAs is we're buying these treasury bonds. There are lots of other kinds of bonds that we could buy. In fact, the city that I live in Falls Church, Virginia, USA, has a AAA credit rating and has issued a bond at like 2.5 times the treasury rate to build a new high school and build new schools, roads, hospitals, parks, water treatment facilities, stuff that is actually good, and has a higher credit rating than the United States government, which is now AA plus instead of AAA. So I think there are ways with just as much security as US Treasuries that could be more decentralized, that could be more localized to bring that yield on chain, but we haven't seen it yet. And maybe that's because RWA is still a very new category, or the people that are making RWAs are afraid to do anything, too creative. And the people who are willing to do more creative things are like Boyan and are making actually decentralized stablecoins instead.
And then you just described for this kind of more like, they are not, these assets are not, they're not liquid. That's the main issue with this. So you have real world assets, and we ended up with treasury bills because it's a very liquid market. And as soon as you tap like in other markets or less liquid, then yeah, how are you going to do liquidate basically if something goes wrong, and then you have timing risk and those kind of things. So I guess this is the reason why we don't see more of this.
So there's no market on earth that's as liquid as U.S. Treasuries, right? But U.S. municipal bonds is a $500 billion market. That's like pretty liquid enough for me.
Yeah, but I think he touches one. If you say, you know, why is it a centralized system? Because the U.S. government basically has the right to mint, like, yeah, they create the U.S. dollar, and you have to move in a way. You would need to find a solution where you replace basically the nation state money, and you have a different money who's like working completely differently. Then you maybe can have like something who's like independent, decentralized, who is not like degenerate, leveraging up. That's the only way I see. But then you have the issue that the price is not then. Yeah, what's the price of these assets? You know, it's like volatile, like Bitcoin. Yeah.
So I guess there's three types of yield. There's degens trading, emissions, and the United States military-industrial complex.
Okay.
The previous panel they touched on a bit on risk, and Joseph brought an interesting case here of like, okay, well, you know, like municipal bonds are actually safer, but you know, like
Maybe.
yield is higher. Boyan, like, do we have that on chain? Is lower yield implying lower risk, or is it just a skill issue, like somebody can't make good yield?
Can be both. That's why I like the previous proposal about a neutral risk assessment council or whatever. In general, yes, lower risk implies lower yield and vice versa. The bigger problem I see is that people usually do not take into account the risk factor to a sufficient degree, at least in my opinion, or they don't value decentralized coins to a sufficient degree, or what I would think, but then I'm biased, of course, until something happens like the Silicon Valley problem in 23, then all of a sudden everyone wanted to hold LUSD at that time. So if external influences force people to think about the risk factor more, then true DeFi projects and assets gain popularity. If not, then we gravitate towards the higher yield pretty much and point games.
So you know, just building on that, like what's a risk framework where you see like what are sort of underpriced risks or risks that are not priced in and should be? Is it, you know, redemption possibility? Is it like smart contracts? Is it bridges? Like what are some underpriced risks that we should think of?
Very complex topic, because you have to take all of those into consideration. On top of that, you need to take into consideration what some DAOs or owner of the contracts can do, multi-sig issues, takeovers, front-end issues. It's a whole spectrum, and it's very hard to unify and to quantify. Hence my question earlier, how would that be executed? For me, it's important that everything is predictable, everything is verifiable on-chain, and then people can decide what's best for them, pretty much. If all the cards are on the table, if all conditions and reactions of the system to them are known, then people can decide if they want to look into that at all.
Is our equivalent of risk-free rate the ETH staking rate?
Oh, that's a good one. I agree with that. Yes, that should be the baseline. And also the underpriced risk is crime. and a lot of people are going to
Unpack that, please.
Yes, because you can just deposit over here and it's 20%, and don't worry about the black box behind the chair, and don't look at the mirrors and the pulleys over here, you know. And how many times has that happened? Every time. Every 4 years, an exchange explodes because it was crime. And it turns out all the investors who were looking for yield from the degens, right, I guess, who were trading on it. The cool thing that I like about Liquity and why I became a Liquity user and obsessed with it is because even if Bojan decided to be a criminal, which he's not, he's a great guy, I promise. But even if he wasn't, he doesn't have any power over the protocol. He can't do anything about it because it's totally immutable. And so it's more than just maybe this multi-sig will have a security problem and accidentally sign away $1.5 billion to North Koreans. Oops. It's actually, I think, a higher risk. Maybe the signers will decide anytime between now and forever that they want to be evil and steal, because it's very tempting. So, yeah, immutable code.
Yeah, but if I can the other side. Now the question is, do you optimize your system to be? Do you have an optimistic approach basically? And optimistic mean you take more risk in your system because you know most of the time you will not hit this kind of threshold, and then you have some kind of insurance. If the edge case hits you have insurance who basically helps you to recover from this loss. Because what I see many times, like DeFi is most of design is very risk averse in the sense it's always on the lowest possible, on the safe side basically. So we optimize for the worst case. And I think this is long term. I'm not sure if this is a valid design pattern, in the sense that if in the real world you optimize, you build your system that they're resilient in a normal case, in a normal environment, and if something, it depends on the system, if about standard life, then not. But normally you try to make it resilient, and if edge case hits, then you have insurance who pays you back or something like this. So it's like, I agree, Liquity is everyone likes it, but is it how do you think this fits into this? Because we over-optimizing in the sense to have it resilience, and we pay a price somewhere for this in ossification. Once you have it, then you can't change it anymore, and maybe it's not, even now it looks valid, but is it valid in 10, 15 years?
It's a totally different problem. Yeah, not being flexible with the product is of course an issue, but I think it's a good option for those people who value those characteristics that Liquity, for example, has. And I don't want to talk about Liquity all the time. What I'm more bothered by as a DeFi user, and I mostly fully came into DeFi because I wanted to use a different financial system where I have full control of my assets, is that I have to always check docs before I go into any new farm. And I hate reading docs. I just want to have a nice table, and here it says 22% and here 18%, and I click on the 22% and everything is perfect. Maybe Joseph looks even at the code and stuff, but even reading docs is so annoying, and we can't expect people to join this industry if they always have to do due diligence and I don't know what, and even then they are only 63% sure that nothing will go wrong within the next 82 days. It's exhausting, and that's why I, after 5 years of farming or whatever, am gravitating more and more towards the safe options and not stress about even if I'm getting 6% less in yield or whatever.
Yeah, and I think one of the reasons why I like Liquity is like even though it's ossified, right? You can't change this implementation. Let's say the team wants to roll out a new version, you roll out version 3. and people can vote with their wallet. They can, in essence, migrate their CDPs to the new version if they like the new parameters. So it's, forking is underutilized in our space.
Not anymore.
Yeah, I think, in a way, I have my own, I worked before I joined Curve, we tried to make the fork on the Liquity V1 version, basically. And at this time, I even approached the team, I was like, I want to build like a copy, can you support us? And the answer has been like, I don't know, we're not sure. And I'm very happy that now you changed like the approach, because now you're very fork friendly, and I think, talk should not be about liquidity, but I think it's a great blueprint to be fork friendly, because then you can basically, as an original copy of your protocol, you can just wait the others like finding out what's working and what's not, and at some point you can maybe take this learning and make as a version 3, as you just said. So it's like it's a very different approach to new versions. Sorry, we're not talking about the yield-bearing stablecoins anymore. But
no, it's. I mean, I think it's like a very interesting perspective, especially because one of the default measures of risk everybody loves in our space, because everybody's like a Taleb fan, so everybody's like Lindy effect and all that stuff. So like having something tried and tested is probably the easiest proxy people use for.
Yes.
Like it's like how much capital has been in there for how long is like how people perceive risk.
Yeah, I think, sorry to extend it, but in a bit also we have a low innovation rate. Even our space is moving fast, but the innovation rate is not very fast, and because you have to write your code, you have an assumption, then you have to audit, then you go live, and then it works out or it doesn't work out. So it's very, very slow, and I guess this is also a way where you can basically speed up the innovation rate like this. So it's like...
Speaking of innovation, we're seeing like... Actually, like, what was it? Like Delve before ElementFi were like the first ones to do sort of like fixed term yield products, and now, Pendle is doing like pretty well on that front. And we're seeing like more and more fixed term yield products come out. Like how's that gonna change the yield behind stablecoins? Is it gonna change it? What's the impact gonna be?
Well, we've had variable rates forever. And then there's a couple fixed rate things. But what about choose your own rate? Who's ever done that before? That's totally new, right? So I think I don't know, the yields being, fluctuating, okay, it's not very reliable, but it's probably higher than you have to pay a premium if you want the fixed rate, right? So there's always a premium on the YT token on Pendle, right? Because if you want reliability, that's something else, that's a feature, you have to pay for that. So I'm generally happy not doing that. I think it's fine. I feel like there's been a narrative for many years of like, we need fixed rate. This is how we're gonna get TradFi because they like fixed rate things. I don't know if that's true. Like, does it really make a difference? People have tried fixed rate things many times now on chain, and it's never really caught on. Besides Pendle, which is not about, people don't go to Pendle because they want a fixed rate loan. They go to Pendle because they're degens and they want to gamble on what the rate is going to be in a month, right? And so you can get leverage on betting that the rate is going to go up by 0.1% and then make 100x doing that. So again, that's not actually like a fixed rate product, that's a degen product.
Yeah, I agree on this. Totally. Because what you see, it's like, I call it DeFi is mostly like pooled finance. So it's like ongoing, endless. And the fixed, like the traditional finance is always like fixed in a sense. You have a duration, then it ends. And somehow nobody really find a way to DeFi, to make system hook. You can roll over like your fixed rate and these kind of things. And maybe it's just a bootstrapping problem. I'm not sure, because Llamalend has been at the start it was like fixed. You had your own loans.
But
You got the code.
barely anyone ever used that. Like the amount of liquidity in Aave fixed rate is like
Yeah. No,
tiny,
it's
minuscule
like
amount.
before they made the Aave version, this one, they had an iteration where
Yep.
basically you posted your own collateral and you ask for a price, and they had the idea that somebody will basically find it and take it from the other side. So it's like an order book. But then we went back to the pooled finance, how Aave is now, how Curve is too. And there are many projects who tried fixed rate on chain, but maybe it's also like a bootstrapping issue in the sense, if our industry grows, then at some times maybe fixed rate products will find again a product market fit and they are back on chain. I didn't see that until now, but it's like yeah.
I'm going to add one more thing and then I'm going to give it the mic back. But there's one thing missing, annuities. You guys know annuities? Who knows what an annuity is? You're very smart. You're the only one in the whole room. What's an annuity? I'm just kidding. It's not a pop quiz. Okay, you can buy a thing one time right now up front for a fixed fee, and then it pays you forever. And it's like the opposite of insurance, right? A life insurance company is betting that you're going to die young, right? Or they're, excuse me, reverse. A life insurance company is betting that you're going to live longer so that they don't have to pay you out. And the annuity is betting that you're going to die young and they're not going to have to pay you for 100 years. So I want annuities on
Assassination
chain.
prediction markets incoming.
Yeah, don't do that. No assassination markets, thank you. So just don't build that. It's evil. It's very easy, but just don't build it. So I want annuities on chain where I can buy something now for $1,000 and then it stays as an asset that can never be unlocked and it goes into Aave or somewhere else and it gives me yield forever streamed to my wallet for 100 years. That's what I want. And
But it's not tied to you as if you die, nothing happens. It just continues to.
Yeah, forever. I don't know.
Isn't that how the wrap stated collateral on Liquity work?
Because there are
Somehow, yes.
more primitives on chain. There are more primitives in TradFi that we haven't brought on chain yet, and I think the streaming capabilities and money streaming for USND, which is our stablecoin from Nerite, could be very interesting to build an annuities protocol on top of, and somebody should do that if you want a hackathon project idea. Yes.
Get the mic. I have a question for you.
Oh, for me?
Yes.
Sure. Go ahead.
So we mentioned bootstrapping challenges. We kind of dunked a bit on incentives and token emissions, but in essence, I believe it's a good way for solving cold start problem. And is there a redemption arc for incentives and points and all those things? Are they still a viable tool we shouldn't discard just because some teams had poor implementations?
It doesn't seem to me that anyone is discarding rewards and points right now. Maybe even to the contrary. It seems you have to do more and more, often more and more to lure capital in. But I mean, if you don't have a product which works by itself, then you won't do much with adding some incentives on top. So it's here to stay. People want it. People leverage it. And there will always be new protocols and always new tokens minted, unfortunately, or it's just the nature of the game. So they are not going anywhere now.
Yeah, it's built into the technology. Basically, we will never get rid of this anymore because it's just what it allows. Basically, you can have an idea. We3 can have an idea now, make a sketch, and then go on a marketing campaign, and people can invest in this way early ideas. And people do this all the time, as we see. But in a normal investment market where people invest in startup, you have your opposite, your contrary is like a professional. And they know 99% of the startups fail. So they don't invest on your napkin math. You don't get money on this. But in our market, you can get a lot of money in this if you hype it up, if you have the right narrative, the right moment. And it's here to stay because it's a form of representation of blockchain that you can like tokenize your early, very, very rough, not finished thinking products, and you can go on the market and people bet basically on you. It's like a meme coin, basically. A meme coin is the more honest form of this in a way, because then you say, we will never have a product, but you can invest in the idea, basically.
This is going south fast. But speaking of tokenizing things and speaking of stablecoin yield, like are the delta neutral? So we see a lot of delta neutral stablecoins being launched. Is this just like a tokenized hedge fund LARPing as a stablecoin?
Yes, it's a tokenized hedge fund LARPing as a stablecoin. And if you're building something that is rebasing and it's just a yield instrument that just represents yield and it just happens to rebase at $1, there's nothing inherently related to $1 about it. It's just rebasing at a $1 price, which is totally arbitrary. You could have rebased it at $3.
But is this good or bad?
I think
That's bad.
No, I think it's good.
No, that's bad because you're lying. You're lying to people about what it is. You're saying this is a yield asset. This is a yield asset that you're calling a stable coin, even though there's nothing inherently stable to the price of it.
Yeah, but okay, yeah, but it's a form of basically you invest in something, and you just looked at the ticket size or the investment size always have like a nomination of $1 basically, or you try to achieve that. But will it, so my question is more, okay, maybe it's not so stable, but is it like, it's more or less stable, or will it depack?
It's lying to users about what the inherent risks are and lying to users about what it works as. There are so many new stables that have been launched in the last 6 months that are yield coins that are being called yield-bearing stable coins just because they're rebasing at $1. You know, they don't have.
You have to be the tie break here. We have it's bad, it's good.
No,
You're the tie break.
It's dishonest because you don't. Let's say I have Walmart or Apple stock. What if Apple stock was always $1? And every time somebody bought it and the price goes up, they just actually rebase the number of shares everybody has. That's insane to call that a stable currency. That's insane. That would be crazy. They would grab all of the financial analysts who said that was a good idea and made Apple stock do that, and they would put them in prison for lying and
why? But
misleading
the usability
investors.
But this means you can use at this. If you match and go further with this, basically you can then buy with your stock everywhere. Why?
I can already do that with Uniswap. Every token just swaps in between each other. It doesn't need to be pegged to $1 to swap between it. That goes nowhere.
Agree,
that's a useless argument.
So, but you wanna tie break this?
Yes.
So Athena kind of solved that issue or answered that question for us. They originally called it stablecoin, I believe, and then they pivoted and kind of publicly announced that they fucked up. It's not a stablecoin, but then no one cared. They put even more money into it. So that's the answer.
So there was a previous panel where Marco from Wi-Fi and Jumper was like, the users don't care. They just want good UI and like high yield. So it's maybe we just give people what they want. Who knows? For your closing thoughts, what is one big challenge that you think is not receiving the attention it deserves when it comes to yield-bearing stablecoins?
I don't even think about that.
Being honest about the risks and educating people about what are the real risks here. With Liquity and Nerite, it's about redemption risk and teaching people how to not get redeemed against, and that what are the scenarios that happens, and getting users to not have ADHD when they're opening $1 million positions and to actually read how it works first, because like Boyan said, people hate reading docs. So that's hard.
That's a nice thought, but I think that even if you put it as a banner on the website, again, people they don't care. Largely, you need to kind of experience some things over a couple of years to start appreciating those things and valuing those things. And I hope that the trend is going into that direction, not the opposite one.
Yeah, I think what would help is basically get rid of the volatility somehow, but it's not like, this sounds like fixed. But what you see is like that in every cycle, real-bearing stablecoin, you get a lot of yield in a bull and not a lot in a bear market, and I think it damages. It's a hindering. Or it hinders us in growth basically, because I said AMM, the site as an AMM, so you have your pools with liquidity in it. We have many stablecoin liquidity, so it's stable. But as soon as the market finds traction, everyone has to pay insane rate to keep like the liquidity in these pools, and you need a lot of money to pay for like 15% APR a year. It's not, you don't pay it in a year, maybe it's only like 2 or 3 months, but at this time you have to pay a lot. So in my opinion, this hinders in a way new entrants, people with new ideas entering this market, because you get outpriced. So this volatility of these cycles, yeah, it's not the best to have, and it's an issue. I guess having more stable situations, and maybe cycles get less volatile in the future, but they're still quite volatile.
Well, thank you guys. If we have some time for 1 or 2 questions, if there is anything from the audience, otherwise we're gonna wrap. Okay. Well, thank you guys for joining me here and for the
Thank you.
interesting discussion. And we'll see you on chain.
Yes.